This podcast is brought to you by TaxCalc because we know that bringing you the very best in tax, accounts, and practice management software is only the start of the journey.
Welcome to the TaxCalc podcast of the TaxCalc webinar, Essential Tax Planning for Turbulent Times. Presented by Andy North and Dean Shepherd with special guests David Logan and Lorraine Ellison. The original webinar was broadcast on the 6th of September 2023 and can be viewed at www.taxcalc.com/events. Please be aware that deadlines, rates, and other technical details referenced may have changed since this date.
Hello and welcome once again to TaxCalc TV. TaxCalc's answer to the BBC's Newsnight, Question Time and Panorama all rolled into one and made exclusively for accountants. This week we're looking at tax planning with an election potentially just around the corner and a couple of significant financial events in the run-up to that. We thought it would be useful to take a walk through some of the key areas where your clients might need your advice. And to do that, Dean and I are joined today by David Logan, Chartered Tax Advisor and the co-founder of the TAG community, and also by our long-standing friend and TaxCalc fangirl, Lorraine Ellison. With that in mind, I do need to share a disclaimer that anything said today is for guidance only. Individual circumstances will vary, and that neither TaxCalc or the TAG Tax community are responsible for any action taken or refrained from as a result of any information shared today. So, thank you guys very much for joining us today. David, would you mind briefly explaining a little bit about the TAG community to those who are unacquainted?
Yes, thank you, Andy. Yes, my name is David Logan and I am a Chartered Tax Advisor. I worked and trained previously with two of the Big Four, and using that analogy, when you're at the Big Four, you can have a directory with all the lists of services that are available. So if you had any issues, whether it was on professional services, legal, tax, capital allowances, pensions, etc., you would just go through that directory and find a name for someone to assist. So what we've done in the TAG community is effectively created that model for the SME sector, and it allows them to tap into all those individual services as and when they need it. So they have access to a team of over 30 tax advisors, 50-odd financial planners, etc. It's a one-stop shop, in other words. So if it means that they can be a Big Four accountant on the high street.
Excellent. Thank you, David. And Lorraine, you've worked with some of your clients, with David as well. Can you just give us a little breakdown of what you've been up to with the TAG community?
Yes, hiya. Yes, I've used TAG for probably about 5 years properly now. So if the client asks for something that I can't do, then I just get TAG to do it for me. So complicated stuff, particularly around inheritance tax planning or restructuring groups. So I can, when anybody asks me to do anything now, I just say yes, because we can do it. Whereas previously I would send them to another firm to get the work done. So it's great. And I've got a good relationship going on, so I can just send little emails, or can you look at this for me? So it's ideal. So I don't have to say no anymore.
Awesome. Thank you, Lorraine. So there is a lot to cover and we only have an hour. So the plan is to tackle the three of the biggest topics of exit planning, inheritance tax and property incorporations first. David is going to cover off the main points, no doubt with interjections from Dean and Lorraine as well. And we'll take questions on that section before moving on to the next. There will hopefully be some time if you want to bring up your own questions for David at the very end. But we do need to try and keep it to the hour. So keep your questions sharp. Dean will be manning the machine. But before we start, some quick housekeeping. First person to guess whether we're going to send out a copy of the recording at the end gets 100 points. It's a yes. Yes, we are. And the chat options, you've got two. The Q&A is if you want to talk to us. Only we will see the comments if you post them in Q&A. The rest of the audience will not. The chat, however, is for everyone. So if you want everyone in the audience to see what you're saying, use that, but we may not see that. So if you're looking for a response from us, Q&A is the best route. We may pick up some of the points in chat, but there's often quite a lot of them. So without further ado, I'm going to hand over to David, who's going to start talking around, I think we're going to do exit planning.
Yeah, so I think it's really important if we just try and set the scene of where we are today. As we know, we're going to have a general election due before January 2025. Likely date is going to be around autumn 2024. So we've got 12 months from basically around now for any potential planning. We now know that the autumn budget, or autumn statement as it's called, will take place on the 22nd of November 2023. That was announced yesterday. So please make a note in your diary for any details of that will come out. And we're most likely going to have another final budget in spring 2024. So there's some key dates for everyone to make themselves aware of. As a result, it's a bit like the football gossip on the BBC. I spend most of my time looking at the financial press for any tax gossip that comes in. This was a recent headline we've had from Jeremy Hunt, where he's basically ruling out any tax cuts. So that autumn statement that we've seen, he's already potentially ruling out due to the high inflation. And in addition, then we've had the equivalent from Labour, them coming out recently, ruling out any wealth taxes as well. So they're just a couple of the headlines that have come through. So this is a really key slide that's coming up now, and it's really important that you take notes of this. And this was recently announced that the Treasury Committee have asked for a systematic review of the cost of over 1,000 tax reliefs. So this is anything from your incorporation relief to gift relief to business property relief, any relief you can think of, from income tax, capital gains tax, etc., that's open to review and changes. So if you think about it, when every government, they'll come in and say, we're not going to raise taxes, the easiest things they can do is change the relief, because it's a stealth tax. It doesn't impact on the actual day-to-day individual. It impacts on those people who may have higher estates for inheritance tax or capital gains tax, etc., etc. So that seems a really important takeaway for everyone listening. Please be aware that if there is those reliefs, they may not be here in 12 or 18 months' time. So moving on to capital gains tax, there was a report published in 2020, and we've already seen the impact of some of those changes, and that resulted in the reduction of the annual exemption. It went further than what was announced in that report. So much so as going down to £3,000 from April 2024. But the biggest significant recommendation from that report was this alignment of CGT rates to income tax rates. So we just move on to the next slide. You can see how that may impact on potential disposals of capital gains tax. So at the moment, we have a basic rate taxpayer that may pay tax at 10% and 18% if it's on property. That goes up to 20% for high rates taxpayers, so that's your 40 and 45%. The proposed report recommended that we move to a 20% rate for basic rate taxpayers, higher rate taxpayers at 40%, and then go to the additional higher rate tax of 45%. So this doesn't include, this is all assets outside the normal business assets disposal relief, which is currently at £1 million, which is subject to 10%. So we've had no word whether that will change at all. We're assuming that any potential government or future government will allow some sort of asset to be disposed of, business asset to be disposed of at a favourable rate, especially the owner managed business sector. Okay, so we've set the scene. We know where we are in regards to where we are today. We've got some great reliefs that are available. What does that mean for clients? So I think what we need to be doing is thinking about our clients into three categories. We should be thinking about clients who are possibly looking to exit or retire from their business in the next 1 to 3 years. Those clients that are possibly looking to retire in, say, 3 to 5 years, or those clients who are young enough that can basically ride out any type of changes in the next government or the next term of 5 years plus. And then the final category is probably those clients who possibly want to pass it down to the next generation using the current reliefs and systems. So that's where I'd probably look to group them. So what I would do now is I'd probably like to bring Lorraine in, and we can maybe discuss some of those exit planning options that are available, Lorraine.
Right. Well, I've got a couple of clients, and one of them, they've got a family. So they're trying to either sell the business or buy an asset. So one of the things would be, what sort of options have they got for the family planning side of things and protecting their assets and minimising the tax?
Okay, so the first thing we need to do is look at what the family wants to do, who wants to retire or sell their asset. There's a number of options available, especially if they want to pass it down to the next generation. It's important that when families are looking to pass it down, that when they're exiting from a business, that they've got enough to retire on, because a lot of the owner-managed business owners, especially those in their 70s or 50s or 60s, 70s, they'll have built up all their cash asset into that business in order to survive in retirement. So there's a number of options. We've got what we call the purchase of own shares, where they effectively sell back the shares to the business. That's on the proviso that some of the family members are already shareholders in that business. The other option is possibly looking at a family management buyout, where the younger generation use a new co to purchase the shares from their mum and dad and use the cash in that business to buy them out. So as an example, you've got a mum and dad in their 70s. They've got a business that's worth 2 million. They've got cash on the balance sheet of £1 million. They want to pass it down to the children. What would you do in that scenario? What I'd be suggesting is possibly looking at doing either a purchase of own shares using a gift relief option. So we could use the current gift relief under Section 165 to give some shares down to the children so they become shareholders. And then any other shares that were left over, you could do a purchase of own shares, subject to them qualifying, of course. Or the other option is, in that scenario, is that you could buy them out and say, well, actually, we'll leave enough money on the balance sheet. Let's say 200,000, you've got £800,000 available, that there's excess cash. You can use that in your retirement. We'll buy you out for 800,000, whatever the figure is, and bring that all out at the same time. You could buy the shares for 800 off the mum and dad. A dividend goes up to the holdco. Again, that would be tax free, no tax consequences, and that money then could be paid out to the mum and dad, and they could pay business asset disposal relief at 10% on that 800,000. So this is all about creating a exit and a finality when it comes to tax, so that when they pay the tax, they know what tax charge that they paid. So in this example, it would be at 10%.
I've got two clients who have got this scenario, and there's a lot of spare cash, but if they take it out as dividends, obviously they get hit with all the tax on the dividends. So this would be a better way to get them to pay, did you say 10% if they do it before?
Yeah. So, I mean, this is all about triggering. I'll be honest with you, this is all about regardless of business asset disposal relief and all the 10%, this is about triggering a tax liability that gives some certainty. So if we look back at the previous slide, we had a slide that showed potential tax rates of 20, 40, whatever it is. Now, it doesn't have to be a trading asset. It could be a property asset. So that one key message, when you're looking at gift relief and things like that, and property investment companies, they are not trading assets and therefore not subject to the normal 10% rates. They're subject to a different capital gains tax rate of 20%. If, for example, you had a property, buy-to-let landlords incorporated company, which we'll talk about later, in that example, if they were sold, you would be looking at a 20% tax liability on those disposals. If the new regime came in, then potentially they'd be looking at 45% if it was more than 150,000, which, given today's property market, I won't be surprised that, property investment companies will have substantial assets in it. So this is where sometimes it's worth triggering what we call maybe a dry tax liability knowing that the clients have got some certainty on the value that they're getting out and paying tax on, because they'll end up losing half of it in tax potentially under a future government or under future budget changes. So moving on, I think we need to be looking at clients who are looking to exit in the next 1 to 3 years. These are some of the options that are available to them. This is where we've got gift relief under 165. So for those not aware, this is available to trading companies where you can pass shares down to the next generation, and effectively the gain is rolled over. It's a disposal for capital gains tax purposes. So it does have to be disclosed on the tax return, and in addition, an election has to be effectively claimed on that gift relief. And that's really important because it does get disclosed on the individual tax returns. And all that happens is that the children step into the shoes on those shares as they acquire them. We've just talked about a family management buyout. Another option, as of course, is an external management buyout. So this is where, they might have a senior management team who want to take on that company from the current owner manager. And therefore, you could use the same principle of a holding co to buy them out. We've talked about a purchase of own shares. So again, subject to qualifying rules, you could, the individual ones who want to retire, as long as they qualify, they could sell the shares back to the company and allow capital treatment on that disposal. So again, triggering a capital gains tax. We talk about third party and deferred earnout. This is more important for those ones that are actually doing external sales. So, for example, when you're doing an external sale, you might say to the owner-managed owner to say, well, actually, we want you to stay on as a consultant, but we'll pay you out on earn-out over the next 2 to 3 years. In that scenario, you'd want to say to the one who's disposing of the shares, try and trigger as much of the gain as possible up front so that you get some certainty around the capital gains tax that you're going to be paying. Of course, the best option at the moment that's available to owner-managed business owners is pension planning because of the corporation tax rate. So ensuring that, they're using their full release that's available. And you're not subject, company contributions are not subject to the normal individual net relevant earnings. It's just a matter of how much they're allowed to carry forward, etc. So specific advice would be needed on that. And finally, the one here is about group restructuring. So maybe they're not looking to sell. So what they could do is possibly do a restructure by putting in the hold co above their trading co. And if they ever did sell it in the future, then that gain would be subject to possibly what's known as a substantial shareholders exemption. So the gain would roll into the hold co, effectively capital gains tax free, which would mean that the money goes into the hold co. You can't be distributed out because you pay income tax on it, but it just means that the exiting shareholders can then use that money to do whatever they want, invest in their, it could be their pension plan, it could be their pot for them to retire on. So I think at this time, Andy, is it worth looking at any additional questions that have come in on this section?
I'm going to hand over to Dean, who's been running the question machine.
Yes, I've been keeping my eye avidly on the chat and the questions. I think perhaps we've had a combination of comments and speculation more so than questions. Some people suggesting, or at least the OTS suggesting, that perhaps some relief for inflation should come in, maybe return to indexation allowance that we've had before. I'm
a big fan of David's cynical comment about the government stimulate the speculation around CGT by allowing that to happen, which I think David said, call me a cynic, but I think whichever government we have can raise additional receipts from CGT by allowing the speculation of rate increases to exist, thereby ensuring that loads of people push through sales ahead of each budget. Very, very fair point.
Yeah, absolutely. That's a great comment, and that's exactly what it does. A lot of the press, we can talk about previous budgets where there was going to be lots of changes. This is all about speculation, and it's a bit like the football gossip, wherever you see on the BBC or whatever website you look at. It's exactly what it is. It's just creating people to do things about being proactive. I think for me, the most important message I'd take away from this is that it's not the tax rates, it's the reliefs that are going to be available to clients. One of the things I haven't mentioned is, and we'll talk about it, is just, for example, on the OTS, one of the recommendations was the changes to the nil rate band for transfers into trusts. So if we're looking at exit planning, you can gift assets into a trust, claim certain reliefs and get, either trading or non-trading. If it's trading, you've got the benefit of the full relief. If it's a non-trading asset, you've got currently 650,000 that can go into a trust. The recommendation is that where it's a non-trading asset, that those assets should be reduced down to 30,000. So what does that mean? So at the moment, you've got 650,000 that would effectively be exempt from tax. That goes down to 60,000. So you're looking at 590 at 40%. How much is that, Lorraine, in tax?
Oh, I don't do sums. I refer all the complicated stuff to TAG. I don't have to get involved in the technical stuff.
Yeah.
It's just very complicated, and there's a lot of choices, which is why you've got to take a bit of advice. And this is why I just ask the questions to my clients, and then I just say, I'll go and ask TAG for some guidance.
So just in that example alone, you'd be looking at an additional IHT charge of 240,000, or even, a lifetime gift charge. It currently is at 20%. That would, that's 120,000 in that example. Spot the opportunities, speak to your clients, and just put them into those categories about where they may fit in about on a retirement or exit plan, so that at least you can get your ducks in a row.
Okay, I think we've got time for a couple of very quick questions that have come through. So I've got a question here. Would you recommend a current valuation if using S165 or take advantage of the election to value only when gain crystallises?
Well, I mean, if you're doing a 165 now, then I would do a valuation based on today's rates. You'd always do it at that rate. In reality, a 165 election, you don't need a full month valuation. You just need a rule of thumb, that will stand up when you make a disposal. Because at the end of the day, it doesn't matter, because the individual who's receiving the gift, the children, they are taking on the base cost anyway.
Okay. And one final question before we move on to the next segment. If a company is sold and there is an initial upfront consideration and an earn-out period, how is that earn-out period taxed?
Right, it depends. Again, very good question. On the earn-out, it depends if there's any conditions within that sale. So if it's based on only future profits, if you've got certainty, then in reality, the majority of it should be taxed up front. And that's what we would recommend, because if you've got certainty, it means you've got the tax rates. If there is some uncertainty, so, for example, you say, well, we're selling our business for, say, £500,000, or say for £1 million. We'll give you £500,000 up front, and then we'll spread the rest £500,000 over the next, 2 to 3 years. But it's going to be based on the percentage of profit, et cetera, So that's where the Maron versus Ingalls principle comes in, and you have to value that uncertainty. And the single biggest issue is that if there is some uncertainty, then you can't tax it all up front, which means some of it will fall out at the back end. So I'm saying year 3, you end up you'd pay tax on the first 500 plus whatever you want to on the uncertainty. And let's just say 100,000 of it is the uncertain amount you just can't value. You receive that 100,000 in year 3, then you're subject to capital gains tax on those rates in the future years. So that's why it's really important, if you can, any contracts on disposal, try and get as much certainty as possible into it, so that you know for certain what you're going to get. By the way, it's the only time you can carry back a loss for capital gains tax purposes if you didn't receive the money, basically.
Okay, right. Thank you, David. So let's shift on to the next topic. So we're going to be looking at IHT.
Yes. So again, I've already mentioned one of the areas I think that could be possibly changed, because that was recommended. But reliefs are easiest part to change. Ample reliefs within the IHT regime, including business property relief, agricultural property relief. For those that are not aware, what business property relief effectively is where you've got a trading company or a partnership and the owner dies, then subject to certain rules, it effectively falls outside the estate for inheritance tax. So it's available at either 50% or 100%. So easy way to change would be just to reduce that exemption. And the same with agricultural property relief. This effectively relates to farmland. So a farmer owner the asset would pass down to the children outside the estate. So one of the key changes or recommendations that was mentioned in the report was to remove what we call the no gain loss relief that's available when assets are effectively exempt for inheritance tax. So if we use an example, you've got a business that's worth £1 million and it's a trading company and the owner dies and it gets passed down to the son or daughter, 50%, whatever it is. What would normally happen is that asset passes into the estate, the shares, there's an automatic uplift up to £1 million. And in addition, because it's exempt from inheritance tax, there's no inheritance tax. So the son and daughter effectively is inherited an asset that's worth £1 million. This is one of the easiest things that I can see going, and I wouldn't be surprised if we actually see it going in the next 12 months. I can't see it waiting to the change in government because there's already been talk of it. So what we're saying here is that under the current rules, inheriting a business or farm is only exempt from inheritance tax, but it's also exempt from CGT because of the CGT. So what they'll possibly do is just get rid of the CGT uplift. You'll get the inheritance tax, but if similar to, say, a gift relief election, 165 election, we'll see the children inherit the base cost. So the gains are effectively subject to tax if they've ever disposed of that asset. In addition, the OTS have made the recommendation that the CGT rule should be removed for all inherited assets. So very basic planning. And if anyone dies in the next 12 months, very basic planning is that you, husband and wife, all the assets go to either or, whoever the surviving spouse is. The spouse then has got these inherited assets. You could then gift down those assets to the children because normally the capital gains tax has been uplifted. So when you're looking at non-trading assets, that's where you got that's the best way of getting assets down to the next generation, effectively tax-free. So that's another key area for people to be thinking about. Well, of course, try not to die in the next 12 months, but think about what assets you should be giving to children to allow them to get these as tax efficiently as possible. Areas that clients should be thinking, one of the recommendations I would be suggesting, and I think, Lorraine, you've taken this message on board, is that even with every tax return or company tax return, one of the recommendations is we would always suggest is having a balance sheet at the done of whether it's at the accounting year end or the tax year for the individual owners of that business or the directors that you're working on. Do you have any comments on that at all?
Yeah, I think it's a great idea. I've started doing it, and I've started with my own. So I've started doing a balance sheet because you might look at your assets and liabilities, in your own personal circumstances, but you very rarely put the business assets into it, and you just forget about that. So I'm doing my own, and then I'm also doing it with clients. So looking at what properties they own, what's the value of the shares in the business, who actually owns it, whether it's husband and wife or family members, and just creating effectively an asset list, and then also a record of what mortgages they owe out, things like life policies, pension pots, things like that. And I think the first thing is to gather the information. And I find the hardest section is the landlords, the people who've got letting properties. Very rarely do they keep good records of. You can usually get the purchase price, but they haven't got things like the stamp duty and legal fees and the refurbishments over the years. So that's what we're coming across as complications.
Yeah, absolutely, Lorraine. And the key thing is that you've mentioned there is just getting an up-to-date full assets and liabilities schedule of all assets and valuations of the business and non-business assets. And you've picked a really key area there now around landlords, which, being a non-trading asset, will be subject to inheritance tax. You'd also group clients into what I call, the 650, 2 nil rate bands that's available at 325 each, up to 650. We've got the sort of family residence nil rate bands. I wouldn't be surprised if that goes in the future government, but currently, if you've got up to £1 million estate, then under current exemptions and reliefs, there wouldn't be any inheritance tax generally payable on that estate being passed down to the next generation. So I wouldn't be surprised if we see some changes. We'll keep it at the 650. One of the other recommendations we've had, or we've seen, or gossip we've seen, is around whether we bring in a flat rate for inheritance tax completely and just charge everything to a lifetime or on death, and completely wiping the nil rate band. I'd be very surprised to see that coming in. So what do we know today? Right, we've got an estate. Anyone that's got up to 650, etc., look at the estates. Generally, they should be okay. Anyone that's got an estate between 650 and £1 million, then you need to start talking to them. And any clients that are above £1 million, then you really need to be asking them questions about what they want to do with those assets, potentially on death, because anything above £1 million, you're going to be paying tax at 40% of whatever rates they are in the future. For landlords, this is a key one, because the issue you've got there, and going back to my other mention, was about changes to trusts. If a landlord does have shares in a company and it all qualifies, then potentially those shares, you could gift some of those shares into a trust and use up your 650 and not pay any tax on them. And again, what it does, it allows you, as long as they're in good health, those shares that have been transferred into, the owners of those shares that have been transferred into trust, and they survive for 7 years, then they wouldn't potentially be any tax payable. But it allows them to use up their nil rate bands of 650, and it gets the clock ticking. Go back to one of the recommendations earlier that was for trust and bringing it down to 30 grand each, assets going into trust, then clearly there's going to be a potential tax charge. So you've got a window here where non-trading assets, really key that they get those ducks in a row so that they can ensure that the reliefs that are currently available, they're using them to the best of their ability and seeking professional advice. So one of the recommendations would be to use a trust in that scenario. And it does mean that it also allows for those shares to be protected for future generations as well. So you could do A and B shares, for example, so that the mum and dad can still take money out, but still not pay dividends in the trust. Because the one thing you don't want to be doing is paying tax in a trust because of the higher rates that's available in a trust. But again, that comes down to some good planning. The other key area for families, of course, is the family home. This is given the rates of house inflation. And I appreciate that given where we are today in the markets, house prices are certainly coming down. And we haven't seen the end of it, I think, for at least for the next 12, 18 months. They're still a lot higher than they were 5, 10 years ago, 20 years ago, etc. So the biggest asset will be around the family home. So possibly looking at what can be done on the family home might be something to consider as well.
Do you want to take a few questions? Or
Yeah.
So I don't know what you've seen, Dean, but there was one particular. Now this is a bit of a crystal ball, and I appreciate if you don't want to kind of stare too deeply into the crystal ball. But inheritance tax planning, giving the changes to exemptions and reliefs, how do you anticipate the landscape will evolve over the next few years? And then what proactive steps can someone take with clients right now?
Yeah, I mean, to be honest with you, inheritance tax has been primed for change. I've been working in this sector now for the last 13 years, and it's been the one area of the legislation that hasn't been really touched, apart from a few additional reliefs. I wouldn't be surprised if we have the whole lot is completely changed in one form or other over the next few years. So going back to what can you do? Well, you need to look at what the assets are in the estate of each individual. So, put them into categories. If they're under 650, then generally they're going to be fine. You don't need to worry. Once you start going above 650, you then need to look at what type of assets they've got. Are they trading, non-trading? If they're non-trading, what can we do about it? Is it possible maybe put them into a trust, etc.? And then if you're looking at the family home, well, the family home is a completely different animal when it comes to inheritance tax. And it's, generally it can be very difficult to pass that down because you're going to be caught by various anti-avoidance rules, in particular to the gift of reservations or the POAT rules in particular, which is effectively you could gift an asset. You'd have a mom and dad who gifts the asset down to the children, and then the children go and buy them another property and so forth. So you've got the rules where that the asset follows them, and it potentially be subject to income tax. So you've got to be very careful around that. But there is things that can be done, and just being, if they want to downsize, just for some basic planning. One of the areas that has been talked about as well, possibly bringing in a tax on the principal, your principal private residence above, initially, or anything above 2 million. So as you appreciate, if you've got, down south, as we call it, I don't know how down south is, but, let's call, London, southeast way, properties of 2 million, and even on terraced housing, families can easily get that. So, these values for family homes could easily be acquired. And the other area where we think there could be other changes is around the changes to the 7-year rule. There was talk actually reducing it rather than 7 years. So there might be some relief reducing that down to 5 years, but maybe bringing it in a lifetime charge so he no longer is exempt, because cash is the king in this, isn't it? The thing about inheritance tax, the best way to do it, to get rid of inheritance tax, is just to give it away. You'll trigger a lifetime liability in some form, whether it's cash, no tax, or capital gains tax if it's an asset. So, they're the options. It's just knowing what reliefs are available. You just need to look at what reliefs that are available to clients on their assets and go, actually, yeah, this is what's available. And trust, as I said, for me, generally, if this was an exam question, I'll be saying in my exam paper, right, well, I'll be suggesting, right, let's use the trusts, use the 650, because you're using your nil rate bands for non-qualifying assets. And then it may not happen, but at least what you've done, you've got the clock ticking on the 650 nil rate band. So at least you've got some protection in the future as well.
Okay, so Dean, any more questions that you want to throw at David right now, or should we move on into the murky world of where we're going to go further into property, I think?
There's a couple of property ones that I think maybe David would come on to, but there's a situation here that I'm not sure we'll have all the information for David to give us practical suggestions for this one, but it'd be interesting to hear his opinion and Lorraine's opinion, actually, because I don't think this is a particularly unusual situation, and how you might handle that with a client. And someone has posed the question here that they've got a client who is currently living in a house worth around £2 million with a £1 million mortgage. Upon the client's death, that property is going to go to the child. How is the child going to pay the inheritance tax on that? And presumably they'd want to continue living in the property. Any thoughts on that one?
So the property's worth 2 million, the mortgage, you'd be able to offset that in that example. You'd offset the mortgage. So the actual true value would be £1 million on the estate if the person died. Currently, again, we'd need to know a bit more background facts, but assuming that there was 2 nil rate bands and there was the family residence nil rate band, then that would be exempt potentially from inheritance tax. What it doesn't do is give you the protection of anything above 2 million. And once the mortgage is, assuming for every living year, the mortgage is going to go down. So you are going to get slow creep into it. I said one option would be possibly to look at maybe selling the property or gifting the property down and then moving out. And then we need to look at what options are available. The thing about inheritance tax, it's all about you give it away. That's the best way of getting rid of inheritance tax. But the problem is you're going to leave the person who's giving away the asset destitute. So we don't want to be doing that. Those people who are giving away the assets, they need to be looked after in one form or another.
Can I just join in on that one? I have a client, and David's been helping to sort the client's affairs out, and they've done a thing where they've done the co-ownership so that they've both been owned part of the property. So there's a gift going on during the lifetime rather than just on death. So I don't know whether you can add a bit to that, David.
Yeah, I mean, that's just in that specific example, the clients, they live in the house, it truly is a co-ownership. Both mother and daughter live in the property and they share all the resources, all the bills are shared 50-50. So in that example, half the asset does belong to the daughter. So in relative terms, principal private residence relief would be available for the daughter to receive that asset. So all we're doing is tidying it up so the property is effectively owned 50-50, and therefore for inheritance tax purposes, the mother will only be subject to half of that property anyway.
Okay, right. So we've got just around 15 minutes left. So the rest of it is we've kind of already moved into property, but that was the final part.
Yeah, so really, again, it's great to be on this presentation and webinar with you guys. I could talk all day on each of these topics individually, and apologies for having to rush everything. But what I wanted to highlight in the next couple of slides is around incorporations. And the reason why I wanted to highlight this is because over the last few years, we've had a lot of landlord trade shows, and if you've ever been to these things, you get these advisors that will stand up and say, oh, yeah, well, let's go into a corporation. And the reason why all this has come about was because of the changes in tax law, in particular to buy-to-let landlords, whereby mortgage interest relief has been restricted. Now, 5 years ago, it wasn't really an issue because interest rates were so low and so forth, and you might pay a little bit. Now we're talking 9-10%, whatever the rates of the mortgage rates are on these things. It's quite a significant amount. And in reality, when you start stripping out the mortgage interest relief, it does become a bit of a tax burden. I've seen a number of advisors, when we go to these doing presentations, go into incorporation, etc. You'll be fine. Don't worry about it. And why is that important? Because if you've got a buy-to-let portfolio and it qualifies for incorporation relief, then the asset passes you can pass the property into a limited company. You claim what's known as a Section 162 relief, which is incorporation relief. There's no capital gains tax, and the capital gains tax is rolled over. And in addition, if it's a partnership, then the shares will also be exempt from stamp duty. So just looking at this slide, this has all come about as a result of a recent case. Well, recent case in relative terms, it was 10 years ago, was the Ramsey versus HMRC, and it related to a wife who inherited properties from her mum and dad, and her and her husband bought out her brother's share of the properties, and they took on the day-to-day management. And the revenue argued that they weren't a business, because everyone gets confused when you look at incorporation. They think it has to be a trading, it only qualifies for trading. No, the actual definition is a business, and they talk about you have to have working on a day-to-day basis, and the number of properties is also indicative as whether a business is applies or not. So the rule of thumb is around 8 to 10 properties, which was the case in the Ramsey case. I've heard advisors talk about you can do this for 2 to 3 properties, etc. I personally think this is a ticking time bomb because, one, if clients haven't taken proper advice on this and they've rolled their properties into a company, then the capital gains tax on that, the revenue could come back and actually go, you can't claim 162 relief because of XYZ, and therefore you've got to pay the tax. You can't just unwind it, you've got to pay the tax. Clearance isn't possible because you have to self-assess at the time. It's an automatic relief, and you have to self-assess, and you have to make that judgment when you come to incorporation. I think for me, this is just for the accountants on the call. It's just for them to actually take a step back. Incorporation, yes, absolutely is a very key proactive planning tool for clients with buy-to-let properties. But firstly, make sure that they qualify and make sure there's a commercial reasons for doing it. Normally, you have to have a proper period of being in business. You can't just do it on day one and then just flip it into a limited company. There has to be a history and so forth.
So, David, a comment has come in, and we did mention, I think, in some of the promotion for the webinar that the ticking time bomb statement, and one of our viewers has asked us for a little bit of an elaboration on what is the bomb, and what steps.
Well, a ticking time bomb, to my mind, is that this is similar to we're going to talk about R&D. HMRC need to collect as much money as they can. They need to collect, look to see where they can collect tax reliefs, collect tax as much as possible. People have abused the R&D regime, and as a result of that, they're taking a sledgehammer to crack a nut. So I wouldn't be surprised if we see some type of campaign where HMRC look at what reliefs are being claimed by individuals who've claimed incorporation relief on buy-to-let properties and whether they qualify or not. Because what the revenue just need to do is they just need to look at tax returns that have made a claim for an incorporation relief. Because that's the other thing, is you have to make a physical claim on the tax return. You have to put the disposal proceeds in, less the claim, the relief claim, and what section you're claiming it under. And you should be putting in a white box. And all it takes is the revenue to do a campaign on those clients that have done this over the last few years to see whether they qualify or not. Now, as an example, I have heard or seen, or people have told me, whereby they were advised to do an incorporation after one day of being a partnership. So if you go on to the next slide here, Andy, this is the point I really wanted to raise. The true benefit of incorporation is if you're a partnership. And this is where you are a partnership for the purposes of stamp duty. Because generally, unless you're a partnership, you cannot get stamp duty relief when the properties are transferred into a limited company. If you're a partnership, then there is a relief under Schedule 15, Finance Act 2003. It's not an exemption, it's just a relief. Effectively, it reduces down to zero if it's a mirror transaction and you don't pay tax on it. And you have to have a history of being a partnership. And I've seen instances where, and we've had no involvement in it, we don't get involved in any of this type of stuff, but we've seen cases where people have set up a partnership for one day and the next day they've incorporated. That for me is a complete no-no. And there's general anti-abuse rules around that, both in the stamp duty and the general legislation, that will catch that individual thinking that they've got round paying no tax on stamp duty and no tax on the Section 162 in. For my mind, the ticking time bomb is a similar campaign to the R&D, where they'll look to do a campaign to see what people have, looked to incorporated and ensure whether 162 relief is available and 2, whether stamp duty relief is available. Does that answer the question?
If I can just join in.
Yeah, go on, Lorraine.
There's a few ticking time bombs. One is the capital gains tax rate, the withdrawal of more reliefs, tax reliefs, and all the other things that David was saying about increased tax charges at the higher rate rather than what they are now. So on 20% on assets and 28% on property, jumping up to like 40%, 45% and things like that. So that's what I see as the big things that we need to be looking at and asking the clients the right questions. I haven't got the answers, I just got a tag.
I would just like to think that the time bombs no longer tick. I think we've moved on technologically from that. It's more of a bleep, maybe. Sorry, I digress. Sorry, we've got a few minutes left. David, did you want to get on to R&D before you wrap up? Or?
Yeah, just very briefly, just on this, I think, and again, I have already mentioned it, and it's just really following that key message is that we've seen across the board, there's been a lot of abuse of the R&D, especially the SME regime, across the sector, and a lot of, no disrespect, probably cowboy firms out there that have just put in spurious claims, and that's impacted generally across the board. It doesn't matter if you are whether you've done a really good claim as genuine R&D. The HMRC are taking an approach where they will look at every claim, and in majority of cases, they will dispute it. And we have seen a lot of arguments where they'll dispute it. And unfortunately, a client has to make a commercial decision. So as an example, we have seen cases where an R&D claim has been made, the revenue have denied it. It will cost the client, an SME, £6,000 in corporation tax. And they have to make a commercial decision. Is it worth fighting? Because what happens is that rather than, they'll just keep saying no. And then it's up to the client then to whether they want to go to a first tier tribunal. Well, what owner-managed business owner will spend 50, 60 grand on professional fees to save corporation tax or SITs. And that's the unfair thing, I think. And then that's where across the board, my institutes, Chartered Institute of Taxation, CMA, all of them, we've all stood together. I think there's been very much a hammer approach taken by the revenue when it comes to the SME sector. And we're going to see the changes. And again, there's some significant changes coming in next year to R&D. We don't have time to talk about that today, but significant changes where we're going to have a flat sort of regime but across the board, like an RDEC for the SME sector as well. And we've already seen some of that legislation being published. So I think for us, I just wanted to mention that don't get disheartened. First of all, if your client has a genuine R&D claim, then seek, an independent opinion from someone. For example, we do have R&D tax experts in our team that are able to help. But if you do, it doesn't have to be us. It can be anyone who's got a good R&D expertise in their offering, then go and seek it from them. But don't just let the revenue sit there. And it may take, to be honest with you, it may take a case going to the tribunal to fight the revenue. And we're helping one particular client at the moment where potentially we will be doing that, even though the claim is relatively small. Sometimes you just have to take a stand. So it was more just on that to make sure that don't get disheartened, seek help.
Thank you very much for that, David and Lorraine. We've got literally a couple of minutes left. Dean, any questions that you want to bring up from the question machine?
Yes, it's really just a practical point really on tax planning. So if people are doing something, let's say like CGT, planning on a potential sale of a property, whether to do that this tax year, next tax year, 5 years down the line, how do you balance working out potential tax liabilities based on rules that are in effect today or that are coming in versus what you think may happen because of the things that you hear and your suspicions of what's going to come in future budgets?
I'll be honest with you, I get that asked a lot. The one thing I can say is that we know what the tax rates today are. All we can do is give clients certainty. If you were to dispose of this property or this asset, you'll pay tax. I've got no issue paying tax. I mean, this isn't about, just use the reliefs that are available, etc. All I can give you is certainty. These changes may or may not happen, but at least the client can go to bed and sleep easy at night knowing that they've paid the right amount of tax on that particular asset. We're talking majority of the SME sector, and a lot of the business owners today, they've built a lot of their nest eggs into their business. So that's why it's really important. They've understood the implications as well. At the moment, business asset disposal relief is only up to £1 million. Then it goes up to 20%. When you talk to a business owner, all of a sudden, if they're looking to sell their business for 2 million or 3 million, when you're talking 20%, you're sort of okay with it. When you're talking 45, 50%, all of a sudden, you're taking a big chunk of that proceeds is going to be spent on tax. And therefore, their retirement pot has been significantly reduced. At least if they do it today, they've got some certainty. It may or may not happen. It may not happen at all. But at least you've given them the certainty that they know what their pot is. So that was the one thing I said is make sure when you are doing it, give them the example of this is what you'd pay today, this is what you could pay. You just use the example of what potential rates could be. Let them make that decision, but at least give them the choice to do it.
Okay, we got one very quick last question I'd like to ask. Just when is an FIC beneficial instead of a normal company? And then we'd have to wrap up.
So you're talking about a family investment company?
Yeah.
Yeah, these are slightly different vehicles, which allows for shares to be property assets and so forth to be held by family members. So there's the special rules around that. I would just need to take that offline if that's okay, Andy, and if you could forward that to me separately and I can go back to that individual on that one.
Certainly can do. Okay, fantastic. Well, look, we have come to the end of time. We've done a full hour. We kind of scratched the surface of some of this. We did have a lot of questions about R&D come up, and we only had a few minutes to cover that. So I think we will probably investigate doing a special webinar specifically around R&D. But I'm going to have to wrap up at this point. So I want to thank you very, very much, David, and thank you very much, Lorraine. Really wonderful to have you. Covered so much there. My brain is somewhat bleeding. So we will be back back with you on the 27th. We're going to be looking at technology and tax season and making sure that everyone's got the right kit in time for January the 31st and all of that. We've got a webinar coming up on the 4th of October, which I'm very much looking forward to, which is around AML. Keep an eye out. You've probably had some emails around that already. Otherwise, we will be at Manchester for Accountex on the 19th of September. If you can make it, we'd love to see you there. In the meantime, I'm going to thank Dean, I'm going to thank Lorraine, I'm going to thank David once again, and we'll see you next time.
You have been listening to the Tax Calc podcast of the Tax Calc webinar, Essential Tax Planning for Turbulent Times. It was presented by Andy North and Dean Shepherd with special guests David Logan and Lorraine Ellison. The producers were John Davis and Tom Holmes. The original webinar was broadcast on the 6th of September 2023 and can be viewed at www.taxcalc.com/events. Please be aware that deadlines, rates and other technical details referenced may have changed since this date.